Welcome to the Allan Small Financial Show. As always, I want to thank everyone for taking the time out of your busy day, and I'm sure these days are quite busy, to spend it with us. This is a great time of year, one of my favorite times of the year, the time between Christmas and New Year's. We do all our shopping, we get all our presents and gifts, and then we go out and celebrate in the next few days, the coming of 2024. A great time. Everybody seems to be in a good mood, and the markets, for the most part, are usually in a good mood as well. We talk about things such as the Santa Claus rally, and this time of year, as I said, seasonally tends to be one of the best times of year. And so we have a great show for you today. We're going to focus on some important things that I think individual investors should consider before you make your investment decisions. That is our This Week component, but also talk a bit about what has happened recently with certain markets, the indices, how they're faring, etc. So here are our list of things that we want to discuss today. The rise of the TSX and Dow at the end of 2023. It's interesting because had you been an investor in or investing in stocks that trade on the TSX or the Dow Jones, you probably wouldn't have seen much in the way of gains until the start of November. 10 months of basically ups and downs or sideways trading, and all of a sudden, November, December come, and we've seen tremendous gains. Are markets moving too high, too fast? Are they moving too high, too quickly? That's something you hear quite often. Yet I never seem to hear our markets moving down too much, too fast. So interesting idea, and I'm going to show some interesting charts as to tell you why I think that is not the case and why I think markets can continue to move higher. Fed game changer. The Fed recently had their interest rate announcement, and in their press conference, Jerome Powell, the head of the Federal Reserve, spoke about how, I guess he felt we were at the peak of interest rates, that interest rates were sufficiently restrictive enough to bring down inflation. And he actually hinted that there will be some interest rate decreases or bring down interest rates in 2024, something that we have not heard from him. Many of us, including me, thought he was going to be talking hawkishly or the usual rhetoric, talking tough on interest rates. But that wasn't the case. We'll speak a bit about that as well. We're also going to go over some of the interviews that we've had on our show, some of the great guests we've had on our show in 2023. We'll be showing some clips of those interviews. And our This Week segment, what I believe is important for individual investors to consider before you make your investment decisions. Top 3 things that may derail the markets in 2024. These are 3 ideas that I think individual investors should have in the back of their minds and be mindful of or watchful in 2024. And lastly, we'll take your questions. Some of the questions that you have, if you have any, please put them in the question box or in the chat box. Be happy to answer them at the end of the show or over the next couple of weeks before our next show. So without further ado, let's get on with the show. As I mentioned off the top of the show, if you're an investor that has made investments into the TSX or own stock that trade on the TSX, maybe own the ETF of the TSX or the Dow Jones, a smaller index, only 30 stocks, you probably didn't see much in the way of gains. Compare that to the S&P 500 or the NASDAQ, which really took off and moved significantly higher at the start of the year. The Dow and the TSX really didn't do an awful lot. And this goes to show us because, or this teaches us a good lesson, because all the gains, and I mean all the gains on the Dow or for the Dow and the TSX have come just in the last few months. The Dow Jones is actually higher by double digits, higher than 10%, more than 10% gains have come on the Dow just in the last few months. And the TSX has made all its gains since November 1st as well. We have a couple of charts that will clearly show this. First one we have, the Dow Jones Industrial Average. You can see here, this is a 6-month chart, and you can see pretty much how the index has been just moving along, kind of trading sideways, hit a low point at the end of October, and then all of a sudden, bam, stock market or this index really took off at the end of the year. In November, significant highs. In December, significant gains. And, obviously we still have a few more trading days for this year, but things are looking pretty darn good right now if you're someone who owns many or some of the stocks that trade on the Dow. We also have a TSX chart as well that shows us the similar thing. We've seen pretty much sideways movement, ups and downs, but really not going anywhere until the end of October. And then once again, you see the index move significantly higher in November, December. So what do we glean from this? What do we take from this type of movement? Well, number one, you can't time markets, right? You never know when the gains are going to come. You never know. Had you been frustrated or tired of owning some of the stocks that trade on these indices and you sold them, well, you would have missed out on a lot of gains in the last couple of months. As I said, the Dow Jones up well over 10% now. If looking at some of the names, if you're looking at buying certain names that traded on the indices, yes, you may have had some gains because obviously owning the whole index, or perhaps maybe picking some of the winners that were there throughout the year, you could have fared a lot better. But overall, you want to continue to build a diversified portfolio. And you want to own these good quality names, whether they trade on the TSX, Toronto Stock Exchange, on the Dow, the NASDAQ, the S&P, it doesn't matter. And what you don't want to do, or what you want to avoid doing, is trying to time markets. Get in, get out, because as you can see, if you tried to do this over the past year, you would have been you would have been very difficult to do because most of the gains, or if not all the gains, for these two indices have come just in the last, let's call it 6 to 8 weeks. So this, I guess, the main lesson to take away from this is you really can't time markets. You want to own good quality. You need to be patient. As long as your investment ideas are still of good quality, and as long as the thesis or the story remains intact, you need to be patient because good quality investments do rise. We know indexes or indices do rise over time. Good quality stocks do rise over time. And so if you remain patient and in these good quality names, as showing us here with the TSX and Dow, you will continue to rise and your portfolio will continue to appreciate over time. One of my pet peeves, one of the things I dislike most actually, is when I hear the comments, has the market gone too far too fast? Has it risen too high too quickly? And you tend to hear this at times when, like we're going through right now, where the indices are moving significantly higher at this time of year. Well, we know seasonal factors have kicked in. We know that the best 3-month period for the markets is between November and the end of January. So that's not a surprise to us. But I think what is a surprise, or has been a surprise for many investors and analysts and economists, etc., has been how fast the markets have moved higher. And so we're getting this comment of, has the market moved too high, too fast? And the funny thing is, do we ever actually hear people say, has the market gone down too much, too fast? Probably not. At least I haven't heard that. And so it's quite frustrating. It's almost like people are always questioning the ups, but they seem to accept or predict or wait for the down markets. And I'm going to show you a couple of charts here that says, no, the stock market hasn't moved too far, too fast, or too high, too fast. First one is a chart of the NASDAQ. Now, you can make the argument, yes, on the far right, look how much the NASDAQ has gone higher. This is a 5-year chart. So you can see towards the end of 2023, we've seen significant gains in the market. But if you look back to where the market traded at the end of 2021, you will notice that the market was actually higher at the end of 2021 than it is today. And that we're just getting back, or the NASDAQ is just getting back to its previous highs. So I guess to play devil's advocate or take the other side, one could say we haven't really gone anywhere in the last 2 years. The NASDAQ actually hasn't gone up in the last 2 years. It's gone way down and then right back up again, just to the point where it was 2 years ago. So if you're an investor that owns the ETF or of the NASDAQ, or what we call the QQQs, the triple Qs, which is again an ETF for the tech stocks or the NASDAQ, you would notice that you probably haven't gone anywhere in the last couple of years. Again, had you owned certain stocks that trade on the NASDAQ, yes, I'm sure you would have made, you could have made significant gains, but only, or taking a look at the index in general, I don't think it's gone too far too fast. Let's take a look at the S&P 500. The S&P 500 index, you'll notice once again on the far right-hand side of this chart, significant gains. But yet again, going back to where this the S&P 500 was at the end of 2021, where the S&P was around 4,800, and we are still below that, you could then make the argument that since the end of 2021, so for the last 2 years, we've gone down and back up. And in essence, the broader market hasn't really made any gains. So this argument about markets going up too far too fast, I would come back and say, well, it's gone as high as it has, as quickly as it has, because it fell as much as it did, as quickly as it did. And it's just making back the losses that it had in 2022. So 2024, if we reach a new all-time high, I know on the Dow, we actually have reached an all-time high recently. S&P, we're getting closer. The NASDAQ, we're getting close again. Then that's when we can say, okay, we've now reached our all-time highs that we reached back in 2021. Where do we go from here? And in my opinion, I think we go higher in the next year based on a lower interest rate environment, based on the Federal Reserve and Bank of Canada talking a little more dovishly, saying that in essence, we've seen peak interest rates, and now it's just a matter of time before they start to lower interest rates. And because of that, and for that, I guess being the main reason, I think this market will continue to make new highs in 2024. So did we see a game changer, a new Federal Reserve, a new Jerome Powell this past meeting? We all thought that the head of the Federal Reserve, Jerome Powell, would speak hawkishly again, or at least say the things like, if we're data dependent, which he did say, but they're ready to hike rates again should there be a need to do so. Instead, he actually took the other route, which was he thinks, or the Federal Reserve in general believe, that interest rates are high enough to be sufficiently restrictive, meaning we're not going to see big gains in the economy in the US. And the Bank of Canada recently said the same thing, that interest rates are high enough to slow down the rise of inflation and get inflation back to the 2% mandate that both Bank of Canada and Federal Reserve have. So is this a game changer? Well, I think it is, because the Federal Reserve actually went as far as showing us what a lot of the Fed governors were saying in the last meeting. They actually have this thing called the data points, or a graph where they show their points where they think interest rates will be in the coming year. And many of the Federal Reserve governors actually had plots or data points that had, or that showed interest rates being lower, that we may see maybe as much as 3 interest rate declines over the next year in 2024. Again, something we have not spoken about or heard the Fed talk about as yet. Now, I know the market is expecting maybe as much as 5 interest rate declines next year. So the Federal Reserve and the market, once again, are a bit different, a bit off, not exactly matching up, and we'll see who ends up being right. But overall, in my opinion, when you're talking now about interest rate decreases coming, and it's just a matter of time before we see them, that is a huge win for the stock market. As we know, the stock market dislikes hiking interest rates, but when we talk about lowering interest rates, that is what the stock market wants to hear. And certain interest rate sensitive parts of the stock market, like technology, like utilities, like real estate trusts, and many other parts of the market, that's what they want to hear so that they can move ahead once again. And keep in mind, the stock market is always thinking 6 to 12 months in advance. So if we're starting to hear about interest rate cuts, perhaps 6 months from now, the market's going to start pricing that in. And that's probably one of the main reasons why we've seen the stock market move higher here in North America already in the last 8 weeks or so. So we have a few charts here that show the first one, the Fed funds rate increase. And again, we can see how much it increased in 2022, but you can see on the far right-hand side, the last 3 meetings for the Fed, or the last 4 out of 5 meetings, there were no interest rate increases. And I guess pretty soon, maybe the chart of 2024 will look totally different. We'll actually start to see it going the other way, that there'll be minuses besides some of these. We'll start to see some interest rate decreases in the not so distant future. One of the main things I wanted to show is the idea of treasuries, 10-year treasury bonds, the 10-year bond rates, government bond rates in the US and Canada. And you can clearly see how they've come down. Now the 10-year is at under 4%. This shows a 3.91. It's actually, I think, earlier today in that 380 range. It's been jumping back and forth, between 3.85 and 4%. Once upon a time, this rate was as high as 5%. And again, when these rates continue to fall or start to come down, as they have been, this is a good thing for stock market performance and a good thing for individual stocks. I also have here the 10-year bond rate in Canada. And you can see that it is significantly lower than the 10-year bond rate in the United States, under 320. And again, this was much higher just maybe 8 weeks ago. So you can see really how things have tailed off because of some of the commentary by the Fed. And really, is this a green light now for stocks? Well, I guess by the market's reaction over the past 8 weeks and how high it's gone in such a short period of time, I think the market is telling you, yes, this is a green light to be in the stock market, to put more money to work. And I've been doing that with my clients and my investors over the last little while, trying to continue to buy those things that are on the cheap, good quality names, because those are the names that seem to be moving the quickest. And if you don't get in at these lower prices, and unfortunately, if you're hesitating because you're just not sure where things are going, you're going to miss out on some really good quality opportunities. And as I've said earlier in the show, you really can't time markets. So when good quality opportunities come about, rather than trying to time it perhaps to get in at a slightly lower price, if it's good quality, buy the investment, and over time, it should rise. So overall, I think the Fed did, or there was a game-changing kind of event at the last press conference for the Federal Reserve. I think now they're starting to speak about more dovish ideas, trying to speak about more when interest rates will decrease rather than increase. And this is only and can be only positive for the stock market. A number of great guests in 2023, and it was our thought to bring you a little snippet of some of the guests that we've had on over the past year. We've had guests discussing the metaverse. We've had politicians. We've had experts in areas of gold and mergers and acquisitions in the private sector. We've had finance minister coming on our show discussing the state of the economy and the Bank of Canada and how they work. A number of fantastic guests. And what we wanted to do today is just play a few clips from a few of those guests to really just give you the some exposure to the different types of guests that we've had and the quality of guests that we had. And again, if you have not seen the full interviews with these guests, you can go onto our YouTube channel. They're all there. You can go onto my website as well. A lot of will be there as well. We have a number of podcasts, Spotify, Apple. You can check out our interviews there as well. And so just wanted to give you everyone just a glimpse as to what we've done in this past year and how happy I am. And again, to say thanks to all our guests. The start of the year, metaverse was the word that we all were quite impressed with. And today it's maybe changed over to artificial intelligence. But back then, we were hearing about Facebook changing their name to Metaverse. We were hearing about this so-called metaverse. How can you make money in the metaverse? Why is the metaverse important? And is it really the future. And who better to talk to us about the metaverse? CEO of Metaverse Group, Lauren Sugarman. And he spoke to us about how one could profit in the metaverse. How can someone invest in the metaverse? Obviously, you can invest in companies that, such as Meta itself, formerly Facebook, and buy the stock there. But you could also invest, as I'm being told, in, for example, property, real estate in the metaverse. How does that work? And obviously, when we buy property here in actual land in our world here, obviously land is a very a commodity that is not everywhere. Obviously, most of the land here has been built on. But in the metaverse, I would think there's lots of places you could buy real estate. And I've heard outrageous amounts of money being spent on land or real estate in the metaverse. How does that work?
Yeah, so that's a great question, and you're right. There's public equities that one can be part of. Like I said, Roblox. You said Meta, but there's also, as you pointed out, virtual land or virtual real estate, as we refer to it. So today we own over 500 NFTs in places like Decentraland, Sandbox, Orbit, Superworld, etc. That are these digital real estate pieces, and our thesis is quite simple, is that just like traditional real estate, we're there to create a yield. And so we charge people rent to use our land, and we'll create experiences for them.
Metaverse. It was the talk from everyone at that time, earlier 2023. Now I think the talk has shifted a lot to artificial intelligence. So perhaps we'll bring back Lauren and talk to him about the metaverse again and how things have changed. Another great guest that we've had on our show many times, actually, well, a few times anyways, is Dan Kelly, head of CFIB, Canadian Federation of Independent Business. And we've touched, we've spoken to Dan, I guess, a couple of times, asking him how small business is faring during these difficult times of higher expenses, higher costs, higher wages, inflation, higher interest rates. And Dan's been on the show a few times talking to us about what the government can do for small business. And here is Dan Kelly talking to us most recently. What would be your number one thing that you'd like to tell the government that they should be doing?
Well, number one, my usual advice for government, the number one thing they can do is not make it worse. And sadly, as we were talking about a minute ago, the government seemed to be making it worse, adding minimum wage hikes and CPP AI hikes, carbon tax increases. So they're making the job for small businesses more challenging, not less challenging. Secondly, some strategic changes, lowering a couple of tax rates would be a big help, but even giving more time to repay some of the CEBA loans that were issued, that would be also a big help. Third, and this is something that the federal government is already committed to, is lowering a few of the costs that businesses pay. And one of them is credit card processing fees. A lot of merchants in retail, hospitality, the service sector are powered by credit cards. Their customers want to use them. And those fees, the budget promised to lower those credit card fees by up to 27%.
Dan Kelly, a great interview. And as I said, we've had him on the show a couple of times and always giving us the pulse of small business, how things are going. And as we know, small business makes up much of business in Ontario, in this country. And as goes small business, goes really the entire country. We have a lot of large businesses here, but really, small businesses make up the majority of business in our province. About midway through the year, in the middle of July, I had the pleasure of having the Premier of Ontario on our show. Premier Doug Ford was on our show, and it was a great experience. The Premier was very gracious in coming on our show, dealing with his people and him, and specifically a fantastic interview. And he really was able to shed some light as to how our economy in Ontario is faring. And this is what he said about the state of the Ontario economy. With talk about a possible recession the end of this year, or possibly a recession in 2024, how do you think, or what do you think the state of business is in the province of Ontario?
What I see, the business is just booming right now here in Ontario. I'll give you one example. I mentioned all the other premiers. First of all, Ontario is leading North American job creation, economic development. People are investing in Ontario from all over the world, and I'll give you some examples in a minute. But, You know, out of the 60,000 jobs that were produced last month in Canada, 55,800, or let's say 56,000 jobs out of the 60,000 jobs, 93% were created right here in Ontario. That's pretty staggering. And the number of jobs since we've taken office in 2018 is now topped over 700,000. So there's 700,000 more people working today than were working 5 years ago.
When we spoke to the premier, I know that in talking to some colleagues of mine, everybody wanted to know not only what the state of the economy in Ontario is and how we're doing, but everybody was always asking the question, what can the government do to help individuals in Ontario? Obviously, this year has been very difficult. Higher interest rate costs, inflation, higher expenses for small businesses. What can the government do to help individuals and businesses in the province?
What can your government do? What can you do to help these small businesses, to help business in general, or to help the average family in Ontario cope with these higher interest rates and higher inflation rates?
Well, thanks for that. First of all, I understand what the Bank of Canada is doing. I totally disagree with them. They're trying to slow down inflation, and we won't be able to tell the impact for maybe 6 months down the road. Inflation has dropped to about 3.5%. I believe it's going to go down. But what they don't understand is what's happening to the families when they have to go renew their mortgage. The only people that are making tons of money are the banks. When you renew your mortgage, it's hurting families. And really, the monetary policy is a conversation for the federal government to have with the Bank of Canada. It's not our jurisdiction. But in saying that, I'll tell you what we are doing. I mentioned the $8 billion we're reducing off the backs of small, medium-sized companies every single year. We're the only jurisdiction in the entire country that have cut the gas tax 10 cents per liter. That's hundreds of millions of dollars a year. And I just wish the federal government could give people a break on the worst tax anyone could face, and that's the carbon tax.
So again, another great interview from the premier giving us some insights as to what his government is doing in Ontario. And if you didn't get a chance to see that interview and some of these interviews that I'm showcasing today, please go to YouTube, our YouTube channel, website. These interviews are there in full. From the premier, we actually had the pleasure of speaking to his finance minister, the Honorable Peter Bethlenfalvy. The Ontario finance minister was on our show not too long ago, actually. And I really wanted to talk to the finance minister and ask him about, Bank of Canada. Does the finance minister speak to the Bank of Canada? And he told us that he does on a regular basis. I just wanted to get his ideas as to what the Bank of Canada has been doing. Does he agree with all these interest rate hikes? And what are his thoughts on how the Bank of Canada is functioning right now and raising rates 10, 11 times in the last couple of years? Does that make sense? And what effect is it having on Ontarians?
My take on the Bank of Canada is they have a lot of inputs. They get data and evidence, but they do talk to a lot of people to get a sense of what's going on. And I think as a politician, they're independent, but I think also I'm sure people always want to hear what the condition on the ground is. And that's where Doug Ford and our government are very good, talking to people all the time, where they're hurting, what's really impacting. And clearly these higher interest rates, the fastest rise, I think, in Bank of Canada history, 10 increases to 5% now. I think prime is over 7%. It's having its effect. We're feeling it on the ground. People who are refinancing their mortgages, people who are paying increased costs for food and for rent and other inputs. So people are feeling it at a time when there is all this uncertainty. So you'd have to ask the Bank of Canada. I did write the Minister of Finance about the Canada Pension Plan, and because I thought that's very important that we talk about to provide stability where Alberta Pension Plan wants to leave the Canada Pension Plan. And, people work in Alberta and then they retire in many parts of the country and vice versa. So I think it's important that at this time we think about the hardships that people have, the uncertainties they have, and do everything we can to help them.
Patty Lovett-Reed, a friend of mine, Patty and I have worked together for many years now. Some of you may recall, Patty was the chief financial commentator for CTV, and she was on BNN for quite some time. Prior to that, was vice president over at TD Waterhouse, TD Bank. And I've had the pleasure of having Patricia Lovett-Reed on our show, I guess I said a few times now. And I think when you go back over the last year, there's been a lot of confusion as to what the Bank of Canada was going to do, still is going to do going forward. Will they ever raise rates again? Will they begin to lower rates next year? And so I posed the question back a few months ago to Patty, saying if she was the Federal Reserve or the Bank of Canada, would she raise interest rates? And interesting enough, she actually flipped the question back on me. But let's see what she had to say. Based on the inflation rate that we just received yesterday, do you think the Bank of Canada has another interest rate increase up their sleeve before the end of the year? And if you were the Bank of Canada or the Federal Reserve for that matter, would you raise rates again before the end of the year?
Yes, I would. Different central banks. I think the U.S. Federal Reserve has done a really good job. They telegraph. They pretty much always follow suit. Not a lot of surprises, unlike the Bank of Canada, who have been known in the past to surprise us. But when you see an inflation rate of 4%, when you look at mortgage servicing costs up 30%, rent 6%, goods as well as services higher, even if you strip out the volatile components, which would be, of course, energy and food, we're still in August, it's 4.6%. And so if you believe in that 2% target, and if you want the Bank of Canada to have the credibility that it is striving for, the odds went higher on October 25th on the next rate announcement. We could see another 25 basis points.
As I said, I know Patty mentioned or said that she would raise interest rates one more time, and flipped the question around and asked me what I would do. And I actually said I would not raise rates. And I guess now looking back, the Bank of Canada did not raise rates anymore after our meeting. And so quite interesting to our conversation. I know that Patty and I go back and forth a number of times on economic topics. And in this case, I guess I was right this time. Not often I'm right. Usually Patty's right. So it was good to be right, and good to be right for all of us, right? Because we don't want interest rates rising anymore. I'm pretty sure of that. And so this was just a glimpse into the quality of guests that we've had on our show in 2023. You know, as I said, we couldn't put everybody in this little package here to show all of you, but just wanted to show those that are watching today that this is the quality of guests that we strive to have. This is the quality of guests that we look to have in 2024. So as we turn the clock and turn the calendar, I should say, to 2024, I look forward to bringing you more guests with different points of view on different topics and making our show as interesting as we can make it, hopefully answering many of the questions that viewers have. And as always, if you have any questions regarding any of the information our guests are discussing or presenting, feel free to send me an email, give me a call. I can always go back to our guests and get some clarification. So once again, I want to thank all our guests for coming on our show in 2023, and I look forward to a fantastic lineup of guests in 2024. Now we come to the part of the show where I believe, when I actually talk a bit about what I believe is important for individual investors to consider over the next couple of weeks and at this point in time into year end before they make their investment decisions. I think you should be watching some economic data. We've had a lot of economic data come out on the calendar, a lot of it in the US, some of it in Canada. I think you also want to take a look ahead to the markets in 2024. I think if you're making investment decisions today, you want to make those decisions based on how you think things are going to go in 2024, at least the beginning of 2024. And lastly, I think you also want to take a look at stock valuations. What are certain investment ideas trading at? Are they getting a little expensive? Are they still cheap? What are these valuations for these investment ideas? And I think those are the three things you want to consider. So let's take each one on their own at one at a time. Economic data. Now, we've had a lot of economic data recently. We've had a jobs report out of the US, most recently this past Friday. Still fairly strong jobs growth. We have jobs growth out of Canada, again, fairly strong. We've had CPI data or inflation numbers come out of the United States yesterday, showing that inflation is coming down a little bit. Tick down from 3.2% to 3.1%. We had PPI, Producer Price Index, which are your wholesale prices, also showing some weakness in inflation just this morning out of the US. So here we have a chart of the US Consumer Price Index, and you can see exactly what I was saying. When you strip out volatile energy and food prices, the core rate is still 4%, so a little higher than the Federal Reserve would like, but the headline number is now down to 3.1. It would be very nice to see a number coming in below 3, something with a 2 in front of it. I think the market would get extremely excited if we started to see numbers in the 2s, because we know that 2% is what the Fed and Bank of Canada, for that matter, are striving for with respect to inflation. The next chart we have here, actually, we can put that one up as well, is the Bank of Canada overnight overnight interest rate versus inflation. And you can see here again that our rate of inflation is also in and around 3.1%. And you can see here that the Bank of Canada rate is significantly above that, 5%. So again, we have, or the Bank of Canada, I should say, has a lot of wiggle room if the economy should continue to slow. And we're seeing it slowing in Canada a lot more than in the United States. I think that the central bank would have enough wiggle room here to bring down the bank rate, the rate that they charge the banks, and then therefore the banks would bring down the prime rate, which is, as we know right now, is over 7%, as the finance minister said in his interview, 7.2% to be exact. So if the central bank, Bank of Canada, lowers their rate, banks will lower the prime rate as well. And things such as mortgages, lines of credit will become just a little bit more affordable right now. And hopefully that would help stimulate the economy. So first thing I want everybody to consider before you make those investments in the next few weeks is what's going on the economic data and how that economic data will affect interest rate policy and where interest rates go in the coming few weeks. As I said on our list there, look ahead into 2024, I think is extremely important, figuring out what the market trend will be heading into 2024 and at the start of 2024. And to me, I think the trend will be to see greater market breadth. Or another way of saying it, I think we're going to see gains in other areas, not just technology like we saw. We know the Magnificent Seven stocks, the largest 7 tech stocks today, made up so much of the gains that we saw this past year. It's making up so much of the S&P 500. Almost 30% of the S&P 500 today are just these 7 stocks. So one of the market trends, or I think the dominating trend for 2024, will be a broadening out of some of the growth into other areas of the market. So not only do we just have to own some good quality tech names, but I think you should own some good quality banks and pharmaceuticals and retail, even maybe the odd sprinkling of some oil names as well. Different areas of the market I think are going to join in on the party, or join in the party, crash the party, if you will, and also move higher. We're already seeing it happening right now, November and December, or here we are about halfway through December, last month and a half. We've seen a number of names in other areas other than technology start to do well, especially banks. Canadian banks have moved higher. US banks have moved a lot higher. Insurance names have moved higher as well. So we're starting to see a broadening out. And I think this trend will be very obvious as we head into 2024. A few charts we have to show that we've seen before. Magnificent Seven dominating the market. We've seen these charts, I think, on previous shows. First one, or actually we have both of them there. On the right-hand side, you'll see the Magnificent Seven, or we call them now the Mag Seven. We actually make short forms of everything in the financial world. And you can see here Meta, formerly Facebook, Amazon, Apple, Microsoft, Google, or now Alphabet, and Tesla and Nvidia. And you can see that these 7 companies made up just over 70% of the growth that we saw this year on the S&P 500. The left side there, that chart shows us that these names make up almost 30% of the S&P 500, and it is unbelievable. You know, Goldman Sachs was quoted recently as saying they have never seen this type of concentration ever before in the stock market. So we're living through a time that we've never seen before, domination by these stocks. The third thing that I think individual investors should consider before you make your investment decisions are stock valuations. And I think the best illustration I have for stock valuations is the first chart we have here, again on the Magnificent Seven. You could clearly see that many of the Mag 7 are trading at high valuations, high PE multiples. You're looking at Amazon 50 times, Apple 30 times, Meta, Alphabet in the 20s, which is a lot cheaper, Microsoft a little expensive, 35 times. Look at Tesla, 73 times. Unbelievable. So I think before you make your investment decisions, you want to take a look at valuations. Now, I will say that if a company is growing profits by 40% with a PE multiple of, let's say, 23 times, then I think that actually makes sense, right? You want to buy a company that is showing growth higher than what your multiple is, what your company stock is trading at. And so I think you'll find that names like Alphabet, Meta, two of the names that many people talk about that are still relatively cheap as compared to the growth that we see in these names going forward. Another one is actually Nvidia. Nvidia, once upon a time, traded at 50, 60 times earnings. Today, earnings on a forward basis, multiple is around 25, 26. And yet they're still growing well above that. And so for many, Nvidia has been a name that they've been adding to over the last, let's call it, 6 months or so. Another chart I have here, again, illustrates valuation of the Mag 7. And you're looking at the Mag 7 or the Magnificent 7 versus a lot of the other indices or index that we could see, the S&P 500, S&P 500 equal weight, EFI, which is your international markets over in Asia, MSCI as well, emerging markets. And you can clearly see even an emerging market index trading at 14 times, the Magnificent 7 well above that at 35 or almost 34 and a bit times earnings. So valuations, I think, is so important before you make your investment decisions. So you want to look at other areas of the market, not just the Mag 7 for growth. There are a lot of areas, as I mentioned, in banking and pharma and other areas in retail that I think are pretty compelling. Some valuations are pretty compelling. A lot of these stocks, in my opinion, are trading at pretty good levels, pretty cheap, on sale, and are still showing some good growth. So to me, over the next couple of weeks, I think if you, as an investor, if you focus on those 3 things before you make your investment decisions, I think those are a good starting point to help build out your portfolio for today and over the next 6 to 12 months. So I wrote here, or we have here on our screen, 3 ideas that potentially, and I say potentially, could derail the momentum that we're seeing in the stock market, the economic momentum that we've seen to have over the last, let's call it 6 weeks or so. And here they are right there. Central bank policy affecting interest rates. We know central bank, the Federal Reserve will set policy in, I guess, just over an hour and a half from now. And that'll be their last meeting for the year to set policy. But what are they going to do in 2024? Stock market valuations getting too high. We talked about valuations earlier on the show. I think if stock valuations get higher and higher, that will be a negative and could derail some of the momentum in the stock market. And the third thing I put down on our list as a top three, part of the top three, are geopolitical events, the US election. And so I wanted to touch a bit on that as well. So let's speak about the first one, central bank policy affecting interest rates. And a chart we've had up on the show a few times, Fed funds rate increasing or increases since 2022. You can see many of them here. You can see also, and more importantly, the last 3 out of 4 meetings, there was no increase. That's big because that tells everybody that the Fed is on hold. And many people believe that the Fed will be on hold in 2024. So I think with setting policy, it's not so much we're worried about interest rates going higher. I think it's more, when will interest rates come down? When will the Fed and Bank of Canada decide to lower interest rates? And I think that is what I mean when I say central banks setting policy that will affect interest rates. When will interest rates come down? We know they were too slow to raise rates. Will the central banks be too slow to lower rates? We have our next chart here, which is a Bank of Canada policy interest rate, where you can see the number of times that the Bank of Canada has raised rates. And again, this is something that as we move forward, will the central bank, our central bank here in Bank of Canada, will they lower rates, and how soon will they lower rates in 2024? Definitely will affect the stock market. Stock valuations, stock market valuation. I have that as second on our list as a potential to perhaps derail some of the momentum with the stock market. And we have a chart here on PE ratios, S&P 500. You can see a huge spike in the chart here in 2021. We can put up that chart. There it is. And it comes almost crashing down again into, I guess, more manageable and better levels. And as you can see in the right side of this chart, valuations are starting to tick higher again. So will valuations get ahead of themselves? And obviously with interest rates at these levels, it's easier to get ahead of yourself. If we start to see interest rates pull back, if the Fed and Bank of Canada start to lower interest rates, it will help stock market valuations a lot more. The third point, or the third thing I wanted to discuss briefly, is this idea of geopolitical events or geopolitics and the US election. And, unfortunately, a lot can happen if the war, for example, in the Middle East were to expand, if the war between Russia and Ukraine were to expand, if we were to get some new event pop up, geopolitical event arise, it definitely can affect the stock market for a very short period of time. We have a fantastic chart, one of the last charts on the show today, and you can clearly see here, we can put that up, the impact of war on the markets and, or really any negative event on the markets. You can see here, the one at the bottom is COVID pandemic and how long it took our markets to get back to where they were prior to shutting down for COVID. 4 months. Can you believe that? It felt like forever, but the stock market rebounded a lot quicker than the economy, and most of us did. And you can see here everything from the Korean War, Cuban Missile Crisis, to the financial crisis, to the 1987 stock market crash. You could see how long it took for the stock market to recover, but it always recovered. Sometimes took a little longer than others, but overall, the market always recovers and moves higher than it was prior to that event happening. So I guess my point is, a geopolitical event, a new event, or something to do with the current events that are going on could derail the momentum for a short period of time, but over the long term, I think you're going to be just fine. And lastly, we have a US election coming up in 2024. I think no matter who is elected, usually we see the stock market go higher. And we have a chart to show this as well. Stock market always moves higher in an election year. But of course, depending on which party wins, it looks like here, if you look at the numbers, Republican wins, market goes up a little bit more than if a Democrat wins. If a Republican replaces a Democrat, you can see how much the stock market goes up. If a Democrat gets reelected, how much the stock market goes up, et cetera, et cetera. So there are a whole bunch of statistics, and you can see on the right-hand side all the different presidents and how they fared, how the S&P fared when they were elected. Some of them, unfortunately, took office at a time that was challenging during a financial crisis or something along those lines. So sometimes it's not about the president, it's just a matter of timing, I guess. But overall, geopolitical events, the US election could derail the momentum of the stock market. Hopefully it doesn't. Hopefully the market is happy with whoever is in the White House come, I guess, 2025 when they take over the office and is elected in November 2024. But overall, those three things, in my opinion, are three things to perhaps look out for as we head into 2024. Now we come to the part of the show that I like best, where I get to take a few of your questions. And as always, show always goes so long. We have so much information that we want to get out to you. We had some great interviews we wanted to revisit. So the show took a little longer than normal. So I think I have time to get to one question. And I'll just choose here. There's a few that came through. With the market volatility right now, should investors be selling higher risk investments and moving into GICs or bonds, or maybe even holding cash? So this is an interesting question because I've been getting a lot of questions. Should I be buying GICs or even money market funds because they're paying 5%? And I think I touched on this a few shows ago. The answer is very simple. It's all going to come down to what type of investor you want to be or what type of investor you are. Are you a risk-averse investor? What are your investment objectives for the money you have that you want to invest? Do you want to see growth? Do you want to see preservation of capital? Do you want to earn an income? All this will play a factor as to what type of investments you want to own in your portfolio. Even if the markets are volatile, and really, they're always volatile. Let's be honest. I know the VIX right now is trading at an all-time low, the VIX being the volatility index. It's trading at a low point right now because there's not as much negative volatility out there. But we know that there's always volatility. There are always storm clouds on the horizon to be mindful of. But as long as you own good quality investments, we know that those rise over time. So the question is not about risky versus not risky. It's more a question of what makes sense for you. What are your investment objectives? You can own equities, stocks, mutual funds, ETFs in a volatile market. But you can also own bonds and GICs as well for money you just don't want to lose, more preservation. It's more of a parking lot versus growth avenue for bonds and GICs. So if you're owning fixed income, consider it as the more boring, more mundane. You earn a nice interest rate today, 5% versus a few years ago, 2%. But you're not going to get much growth after you factor in taxes and inflation. But if you're okay with that, and if you have a portfolio that can take that into consideration, you have enough invested that you don't need to have everything growing for you, then bonds and GICs can make up a portion of a portfolio. So with that, I want to say thank you once again for taking time out of your busy day during this time between Christmas and New Year's to tune into our show. I want to say tune into our first show of the new year. That will be on Wednesday, January 10th at 12 noon. We'll have a great show for you then. Very excited. The new year kicking off. We'll talk about the look ahead into 2024 and what is exciting coming down the pipeline. So until then, have yourself a great New Year's and enjoy this holiday time with family and happy investing.